Well, as far as I'm concerned, the negatives of forbearance is that you're pushing interest off to a later date. You're going to pay it anyway. People who have escrow accounts that don't understand that they're not making payments into their escrow account along with not making their mortgage payment don't understand that not only are you behind on your mortgage, if you miss 6 payments, and that's the maximum forbearance is 180 days, miss 6 payments from May 1st, that puts you to them dispersing taxes out of your escrow account to pay property taxes. If you haven't paid those 6 months in, that's a big chunk. Forbearance is a great topic.
You don't think it is? No, I just want to get audio. Yeah, we're not talking about that today.
I was just telling you, if we're going to continue on the topic of forbearances,
Yeah, no, it is what it is. All right, so today we have Dave Stahl back on today, and we're going to be talking about mortgage, most likely interest rates. You want to talk about interest rates today?
Talk about interest rates.
Yeah, let's talk about interest rates since yesterday you said that's what people really care about is get my deal done and get me the lowest rate. So we're
kind of like you go to buy a cell phone. You want to know about what the where it used to be. You want to know how many minutes are included in the plan, how much data is there in the plan, because those are the questions that you think about. Whereas maybe you should think about, or you used to you should have thought about how many minutes do I use a day, how many minutes do I really need in a plan, rather than oh this plan's $50 for 500 minutes. Well, same type thing holds true with mortgage. People don't know what to ask, so the immediate question they ask is, what's the rate? Because that's what they know to ask or what they feel like they should ask, when it should be more what program or product best suits my need. But they don't know how to ask that question because that's not how they look at mortgage. They look at mortgage as what's the rate?
Yeah, definitely. So when I go online and I search for interest rates, normally I get one of these big box companies and they're showing 2.66% rate. I even get emails from, Lending Tree or whoever it is at 2.66 refi. How much truth can I put to that, or is there a catch to those?
I'll put it this way. I've got a client of mine who's down in South Texas, and here since the this shutdown and rates dropping and all this insanity, he's called me about once a week. And he's an older guy. He's 82. He's got a 30-year fixed rate on his mortgage. He's got a pretty good deal because that's what we did to begin with. And he continues to look at it, and it drives him absolutely crazy that there is no benefit in him refinancing what he owes from a three and a quarter 30-year fixed to a 2.75 15-year fixed. And the part of the reason is his age, and he keeps looking at the timeline going, man, I'm never going to recapture. But that's part of looking at each person's scenario and understanding what fits and what doesn't fit, right? So this guy at 82, he's looking at it going, dang it, I'm going to save like $30 a month. Okay, that's not a big deal. It's going to cost me $2,500 to $3,000 to do it. That is a big deal because you got to look at how long it takes to recover the money. And the whole deal comes down to, could he get 2.75, and would it be reasonable terms? Absolutely. But does it make sense for your scenario? And for most people, when you're fishing with low rates like that, at some point the math is the math and things come out in the wash and you look at it and you go, this makes sense or this doesn't make sense. And there are a lot of places that you can call that they're only going to stand on the side of what makes sense. They're never going to tell you the parts of it that don't make sense.
So let me ask you about that then. You put an interest rate, it's lower, it saves your customer 30 to 100 bucks. Really doesn't look great because it cost them so much to make the closing. But what about the overall interest? I mean, let's say you're saving 20, $30,000 in interest if as taking that out.
It depends on what you owe, right? As to whether it makes sense. And, like in this guy, I'll keep using this guy's scenario because if you stack it up against somebody who's 30 years old versus somebody who's 82 years old, The 82-year-old guy doesn't have the same scenario as the 30-year-old guy. Now, the 30-year-old guy, if it takes 7, 8 years to recover the cost of doing it, may not make sense because most people, through research, have the same mortgage or the same home for 5 to 7 years. If you're not in there long enough to recover the costs, then it doesn't matter what you do, it doesn't make sense. If you're not alive long enough to recover the cost, it doesn't make sense either. So, it all comes down to what makes sense, what doesn't make sense. Now, most of the time, if you recover the cost in 36 months or less, it's something that makes sense to do. So, there's a lot of different ways to do it, but primarily what I look at is the situation, the 36-month threshold. I'm big on that. And, it's not just about the saving $100 a month. Because if it costs you $7,000 of your equity to do it, did you really save $100 a month? No, you just put it back in a loan.
So what is your threshold then? If it costs you $4,000 to $7,000 and you're only saving $100 a month, yeah, you can, figure out the math on how many months it takes you to get it back. So what number are you looking for that you say, you'll recoup this in 36 months, and then you start going on to the positive side of saving money there? What's the number you look for?
Well, the 36 months is primary. I mean, because if I'm saving $100 a month and the cost is $3,600 to save $100 a month, then yeah, that makes sense. Now, having conversations with people is also critical in that, if you're talking to somebody who's going, "Hey, Dave, we're going to be moving in a year and a half," well, my 36-month equation just got tossed out the window because now I just had him give up essentially $1,800 of the 36 to save $100 a month for 18 months, and he still never made up the other $1,800. So, like I said, it's critical for everybody to understand their situation and not just read an email that says, "Hey, you can get 2.66 or 2.75 or whatever the number is," because there's a cost associated with everything, and it actually has to make sense. I mean, I had a conversation with a gentleman yesterday who we were talking about this very same thing. You could get a 30-year fixed rate today at 2.75%. You can also get a 30-year fixed rate at 3.5%. The difference in those two loans and I think we were talking about a $300,000 loan, that $300,000 loan at 3.5%, I can issue a credit to cover all the closing costs. So he's going to go for his 4.25 rate, 3.5%, and have no cost associated with doing it and simply pay a lower interest rate. The flip of that, if we go to the 2.75, he's going to pay a point and a half plus the closing costs. When I did the math, I think it was like 140 months to recover the differential in cost. Obviously, that makes no sense. I mean, certainly you're going to walk around with a 2.75 rate in your back pocket. Over the course of 30 years, are you going to save money? Yeah, but for a half of those 30 years, you're not saving a dime. Rates are great. I'd love to walk around with a 2.5% rate in my back pocket, but how much did you take out of my wallet?
All right, so I'll just take what you just said there. You'd love to have a 2.5% interest rate in your back pocket. So is the advertising for these super low interest rates just kind of I don't want to call it a bait and switch, but just to get your attention to make the phone call to you? And
Absolutely. It's no different than when you hear the weatherman go, "Hey, we're going to have potential severe thunderstorms tonight." What do? You turn on the TV to try to find out, is that going through my neighborhood? Do I need to put everything on my patio in? Do I need to be worried about my hail damage claim tomorrow? Well, yeah, it draws your attention to it. So when you get this email, there's phone call or whatever, whatever it is that says, "Hey, take yourself from your 3.5 to 2.5." Well, yeah, you're gonna research that. Now, the pluses and minuses. Pluses, you're gonna look at it, people are gonna look at it and hopefully do the right research and come to an understanding of what the cost benefit analysis is.
yeah, definitely the details is everything about it. When I look at it though, I mean, just depending on your income bracket, $50 might mean a lot. $100 might mean a lot. $200 is great. What if what about people on fixed incomes who need to save that 50, that $100, and it's about, hey, this is about my month to month, not about how long I'm going to live and if I'm going to recoup money. It's more about a monthly, outflow.
I'll be honest. I run through all those numbers and I come to those same conclusions. Kind of like, I get it. $50 a month is a big deal, but $50,000 more than what you're paying now over the life of the new loan is also a big deal. So I'm happy to do whatever loan somebody wants me to do for them. But if it's the wrong loan to do, if it's the wrong thing to do, I'm going to kick and scream all the way down the road because I'm not a fan of putting people in worse positions than what they're in now. And you're right, $50, $100 a month to some people that's a lot of money. But it's I guess I look at it from the perspective of lending responsibly, and you don't determine what I determine to be responsible. I do. And a $50 savings for you know a $7,000 cost, that doesn't make sense to me. And I'm probably going to balk at doing that loan, and you know I'll let you know somebody else that might be able to help you because I won't.
Yeah, and you keep bringing up the cost. Are the costs that high that it makes it prohibitive? I mean, it seems like, when FHA talks about new home buyers and whatnot, it's all about, you're able to come into a deal and not have so much come out of your pocket. Where are these costs coming from, and why are they so high?
Well, I mean, you've got costs related to the lender. I mean, we've got underwriting costs, we've got processing costs, we've got costs associated with pulling a credit report, costs associated with getting an appraisal done, costs associated with the title company. I mean, they're not going to sit down and sign all the loan documents for free. You also have title insurance that you're partially responsible for. In some states, you pay for all of it. Most of the time in Texas, the seller pays for the most of it. A cost associated with the survey of the property, cost associated with recording the mortgage of the property. You have to pay your first year's homeowner's insurance at closing, and you also have to put money into an escrow account for reserves for taxes and insurance for when they become due. Now, what does that mean? I just named a lot of fees. What's it mean in terms of dollars? I mean, in a $200,000 purchase, you're probably talking about, in addition to your 3.5% down payment, you're probably talking about another 3% of that sales price at a minimum that goes towards that cost. So I'm buying a $200,000 house, 3.5% of 200,000 is what? 7,500? 7,000? So if we say that 7,000 plus another 6,000, you're bringing 13,000 to closing.
Yeah, and so with, that's for a purchase, and then refis, they're just as costly then, huh? I mean, what we're talking about is minus the down payment.
You're not putting money down. You're refinancing what you owe. You're not, most of the time, you're rolling that cost of doing the loan into the new loan. So, not that it's not seen, it's just that many people, when they're doing a refinance, don't look at it because they're just not looking at the numbers. So, I know on my end, we always talk about what your current balance is, what your new balance is going to be, and what the loan amount is. And the question is, well, why the difference? Well, you got closing costs. So that's kind of on my end, things that we talk about is we talk about the cost of doing a loan.
Definitely, and when we're talking about the cost in a refi like that, there's going to be this new wave of people wanting to cash out, maybe, right, to help their situation because of whatever scenario they're in. Maybe they're temporarily out of a job, or maybe they were asked to, get their salaries cut back for 3 months. Like, I know at company that I work for, they have told all non-agreement employees that they're going to have a forced 1 week non-paid vacation per month for the next 3 months. So what do you tell people who want to cash out and take some of that equity out of their home with these low interest rates, even if they might not be able to recapture that?
They're not getting a loan. because you have to be employed. People who have reduced income, you have to qualify based on the reduced income. Um, the other people, I mean, obviously every loan has its purpose, has its place, but we're always going to look at what's the lowest risk, highest benefit for whoever we're talking to. So in a scenario like that, where somebody finally looks at it and goes, "Boy, I have $50,000 worth of credit card debt, and I got a lot of equity. Maybe I should do something intelligent about the credit card debt." Certainly, stuff like that makes sense to do. I mean, I've got a gentleman right now that we're helping him refinance two properties, and with the equity that he's got in both properties, we're shaving $4,000 a month off of his monthly outgoing expense because of all the other debt that he's amassed, not counting car loans, but credit card stuff. So, stuff like that's always going to make sense. Credit card payments, I don't know if you've ever looked at it, but most of the time that minimum monthly payment is set to, amortize that credit card on 30 years or, 25 to 30 years anyway. So by taking it off of the 18 to 24% credit card interest rate and putting it on a home loan rate, certainly you're gonna do yourself some justice. And hopefully you learn from your mistakes and you don't go racking up another 50 grand in credit card debt.
All right, let's talk about it a little bit more like this. So, Dave, I'll ask you this way. Being in mortgages and being more like a finance consultant, really, what if somebody wants to buy down their interest rate? They're not worried about the cost, but they're worried about, let's say they're 30 years old and they have 10, 20, 25 years left to pay on their note. And by getting that interest rate down, they can save a lot as far as the total dollar amount paid out. So what do you think about doing that?
Well, I think that you have to look at the math. Like I said before, if you're only saving, for the back half of your loan, let's say it takes you 180 payments to recover the cost of this buy down. You have to look at, where you think you're going to be in 15 years. Do you think that you're going to be in the same house? I don't know the answer to that for most people, and I say that have the answer to that, and that that's pretty evident when you start talking to people about their own personal planning. You can ask someone to write down goals for 6 months, 12 months, but once you start getting outside of that 12 months, increasing to 36 and 60 months down the road, people have no clue where they're going to be 5 years from now. So to have someone tell me I'm absolutely going to be in this house for 30 years, I find that hard to believe. It's not we're not in the era of our parents or even our grandparents that stay in the same home for 40 years. I mean, I know my grandparents were in the same house from I think the time that my dad was 10 until they passed, which was that's like 70 years. That we're not there anymore. People move too often. People become disenfranchised with their neighborhood, or they're trying to keep up with the Joneses or whatever it might be. So when we start talking about recovering costs 15 years down the road, I have a hard time stomaching that. So on my end, certainly if you want to buy down that rate, I'm going to show you what that looks like. I'm also going to show you what it looks like to just have a normal rate without the buy down, and I'm going to show you what it looks like to have no cost associated. And when you look at all three of those scenarios and you start balancing out the actual numbers of it, you're probably going to lean towards the not buying it down scenario of your equity to buy it down, because most of the time when people are refinancing, they're putting the cost back into the loan. So, let's say you pay a point and a half to buy down the rate, and then something happens 3 years down the road, you haven't recovered the cost, you paid this point and a half, you got to sell your house. Guess what you just did? You gave up 1.5% of the equity of your property.
Yeah, no, the scenario you explained earlier was more appealing, I would think, is that, take some of that equity, pay off your credit card debt. And I hate to say that with equity, but if it's saving you, like you said, $4,000 a month because you pay a bunch of stuff off, but you got to be smart in putting that money back into your house and not just use your equity for credit cards, right?
The right way to go about it is this, Dan, is that you immediately save the $4,000 a month and you start taking that $4,000 and putting it into a base, a savings, a mutual fund, something that allows you to, at a future date, instead of breaking out the credit card, use your own money to pay for whatever the emergent event was. And once you have that base, then you turn around and you start attacking that mortgage debt. But if you simply start attacking the mortgage debt without creating that base, you keep yourself in the same position of, in case of emergency, I'm falling back on the credit card because I don't have any of what I saved put away.
Yeah, so you're talking about building up a reserve from that savings every month then, like build up a reserve of 3 or 6 months for an emergency.
Absolutely. Because if you don't have that reserve, it's very easy to fall back on the credit cards because oh, I'm paying 4,000 a month back into my mortgage and I'm not putting the money to the side. Oh crap, an emergency show pops up. Gotta, do whatever the emergency is. Oh, here's my Visa. That's what's paying for it because you didn't save any of the money that you saved for the reason of being able to accumulate savings, So you've got to, there's steps along the way. You've got to have the savings to get rid of the need for credit cards. And then once you have the savings, you have your emergency fund, then you start taking that excess money and start getting rid of other debts like your mortgage, like your car payments, stuff like that, rather than tapping the credit cards. You're using your own savings to be able to, you know, to use it for an emergency, so to speak.
Definitely, that's good stuff. So, Dave, in closing, why don't you tell people where they can find you, how they can call you, how they can reach you?
You can find us on the internet. I'm not going to spell the website. It has a hyphen in it, and that confuses Dan. So I'm not going to. You can find us on social media, all platforms, Facebook. We're on Twitter. We're on Instagram. You can search for us, Mortgage Exchange. It's X-Change. There's the hyphen for you, Dan. You can call the office 214-383-9400. My extension is 100, or you can just hold and wait to speak to somebody. Text 972-896-8790. I'm pretty available through all of those means.
Awesome. Appreciate the information. We were talking about low interest rates and what you should do when you're considering still purchasing. There, we have purchases available, refi, and what you should do with that money and things to think about. Again, thanks a lot, Dave. I appreciate all the information.
Quite welcome. Thanks for having me, Dan.